Hey, I'm Dennis Tubbergen. This is RLA Radio. Glad you decided to listen in and watch today, depending on how you're checking out today's program. Joining me in the second segment of today's program is Mr. Doug Casey. I caught up with Doug from his winter home in actually South America this past week, and I'll be sharing that interview with you in the second segment of today's program. I get Doug's forecast for where the world economy is going, the U.S. economy, where stocks and bonds are going. You'll want to stay tuned and check out that interview in full. Hey, I do have a brand new special report to offer you that's available by visiting requestyourreport.com. That report is titled 3 Retirement Mistakes. If you are retired or you are aspiring to a comfortable, stress-free retirement, I'd encourage you to go to requestyourreport.com. And just let me know where to mail that free report, and I'll be glad to send it to you. Again, that is the 3 Retirement Mistakes Report, available at requestyourreport.com. Well, some of you may have seen this, but according to the National Association of Realtors, home sales fell month over month and on a year-to-year basis. Month over month, sales were down 8.4%. Nearly 10% fewer homes were sold in January of 2026 than in December of 2025. Now, the chief economist at the National Association of Realtors, Dr. Lawrence Yun, had this to say, quote, "The decrease in sales is disappointing. The below normal temperatures and above normal precipitation this January make it harder than usual to assess the underlying driver of the decrease and determine if this month's numbers are an aberration," end quote. So are they an aberration? Is Dr. Yoon correct? Did the cold weather and above normal precipitation, which really was snow and ice, and there's no denying that much of the United States saw absolutely miserable weather during the month of January, but is that the cause of nearly 10% fewer homes being sold in January than in December? I don't think so. That's not the way real estate works. If you've ever purchased a home, if you've ever purchased a property, any piece of real estate, no matter the type, you write an offer to purchase. That offer to purchase is accepted. If it's a cash sale, it might close in 30 days or a little bit longer. If it's a finance sale, it might take a couple months or even longer for that sale to close. So the sales that closed during the month of January, and keep in mind, these were 8.4% lower than during the month of December. These sales were initiated in November and December when the weather wasn't downright miserable. So there is something deeper at play here. And I've been talking to you about that here on the program. If you look at median home price has fallen every month from June of 2025 through January of 2026. That means every month the median sale price of a home has declined. That is not a strong market. That is not a rallying market. That is a weakening market. So this goes deeper than that. It is definitely a buyer's market. As I've talked about here on the program, there are now 600,000 more real estate sellers than there are buyers. And I expect that we're going to see a lot more downside in this market as well. I've been talking to you also about what's been going on in the precious metals market. It's no secret that if you've been a long-time listener to the program, going back a couple of years, one of my favorite asset classes is silver. Silver has been undoubtedly my favorite speculative investment class, and I've been validated in that belief here over the past year. And despite recent price action, it is still one of the assets that I expect will outperform moving ahead. Now, industrial demand is greater than mining output. In fact, this will be the 6th straight year that industrial demand has exceeded mining output. That alone is bullish for silver. However, there's something else going on in silver. Past guest here on this program, Mr. John Rubino, wrote about it in his popular Substack newsletter just last week. And it is simply this: the number of silver traders, the number of gold traders on the COMEX exchange who are standing for delivery is increasing. What does that mean? What does standing for delivery means? Well, if I am trading a futures contract and it matures, I have a couple choices. If I'm profitable in the contract, I can take my profits in cash, or I can actually take the silver or gold and take physical delivery of it. That is known as standing for delivery. Now, if you look at what's been going on in the COMEX market since the middle of 2024, so less than 2 years ago, the deliveries of physical silver, the number of silver traders actually standing for delivery, have increased by more than 400% in just a year and a half. That, in and of itself, is extremely telling. Silver traders are preferring physical metals to US dollars in greater quantities when it comes time to settle their contract. Now, here is a possible looming bullish storm for the silver market. If this trend continues, supplies of physical silver could run short, and we're getting closer. Doesn't mean it's going to happen, but it could run short. And if that happens, silver prices could move a lot higher. As I close this segment, before we get to my interview with Mr. Doug Casey, let me remind you, you can get my 3 retirement mistakes report. All you need to do to request it is visit requestyourreport.com. I'll be right back after these words with my special guest this week on a pre-recorded interview with Mr. Doug Casey. Dennis Tubbergen here, host of RLA Radio. I'd like to invite you to get my latest special report titled 3 Retirement Mistakes. If you're already retired or you aspire to a comfortable, stress-free retirement, this report will not only outline the 3 most commonly made retirement planning mistakes, but also help you put guardrails in place to avoid them. These 3 retirement mistakes occur because of the macroeconomic cycle that continues to repeat itself. In the report, you'll discover where we are in this macroeconomic cycle and what 3 mistakes you could potentially make as a result. To get your copy of this free report, all you need to do is visit requestyourreport.com. The website again is requestyourreport.com. Just let me know where to mail your complimentary copy of the 3 retirement mistakes report, and I'll be glad to do so. Again, the website, requestyourreport.com. Welcome back to RLA Radio. I am your host, Dennis Tubbergen. Joining me on today's program is returning guest, Mr. Doug Casey. Doug really doesn't need an introduction. He is a multi-time best-selling author, respected commentator, being very generous with his time once again. And Doug, always a pleasure to chat with you. Appreciate your perspective. Thank you for joining us today.
Well, thank you, Dennis. And it's nice talking to you because it's a conversation. In other words, so often when you have an interview on these subjects, people ask the same questions, and all I really have to do is push a button in the side of my head and give the standard answer, which I've given many times before. So I guess we can talk about a lot of things or anything, and I don't have to give a standard answer.
Well, I would love your take. Let me start with Fed policy, if I could. We have Jerome Powell on the way out in May. We have a new nominee, Mr. Warsh, who is allegedly hawkish on inflation. I'm a bit skeptical. Do you think he'd have gotten the position if he was hawkish on inflation? What's your take?
Well, I'm the wrong person to ask. And the reason is, of course, first of all, I believe the Fed itself ought to be abolished. Not only does it serve no useful purpose, but it's the actual engine of inflation. The government sells its debt to the Fed. Chinese, Japanese no longer want to buy it. So, and with the government running $2-3 trillion deficits, who's going to buy the debt? The Fed, and they print up money to buy it. So that's the position that Mr. Warsh finds himself in. He's got to orchestrate that. There was another Kevin that they were going to, that was in the running to be the Fed chairman. But I think Kevin Costner would be the best Kevin to be the Fed chairman because he's a skilled professional actor. And I think actors are best suited for telling lies and making people believe in things that aren't real. So look, the amount of money printing going on in this country has a life of its own at this point. And the Fed is no longer in a position to fine tune. That's a word they used to use, but they don't anymore. They're just trying to keep the whole thing from collapsing with the gigantic amount of debt that we have in the world on the one hand, and retail price rises, which I think are going to get very much out of hand, much more in the years to come. So, no opinion on Kevin Warsh in particular. He's just another suit.
So, Doug, let's continue along those lines because Stephen Moran, who is President Trump's latest appointee to the Fed Board of Governors, in an interview said that the Fed doesn't have two mandates. We really have three mandates, not only price stability and maximum employment, but we also have the responsibility of maintaining stability on the long end of the rate curve. Doesn't that mean that we're in for yield curve control, more currency creation, and more inflation?
Well, interest rates are the most important single indicator in an economy. They regulate how much people borrow, how much they save. So actually, the Fed shouldn't be trying to control any of these things. And how can they control long-term interest rates? Well, really, the only way they can do it is by going into the open market and buying bonds. You buy a bond, price of bonds go up, relatively speaking, and the interest rate in the market goes down. But that's really, they can only do this with printed money, actually. So it's going to be a disaster. Like I said, I don't even like to talk about the Fed because it should be abolished. It really serves no useful purpose. They have thousands of PhD economists running around trying to keep the old system together with chewing gum and baling wire.
So, Doug, give me your assessment of the health of the U.S. economy. Are we in a recession officially, do you think?
A recession. Well, let me start with defining a depression because these words are nebulous and people throw them around in an ill-defined manner. I like to define a depression as a period of time when most people's standard of living drops significantly. So if we use that definition of a depression, a recession, which many decades ago used to be the word that they used instead of it's a moving paper fantasy. They keep changing the definitions and how these words are used. Are we in a recession? Well, it depends on what we're looking at. I'm on a Zoom call put on by Wolf Research every couple of weeks, and they have really top people that run companies, big companies, industries, retailers, massive stuff. And they ask them to talk about how everything's going for their companies. And generally, these guys, big businesses, are saying things are going pretty good. And of course, that's indicated by the stock market, which is doing pretty good, all-time highs. But I think the average guy is struggling. And I think what's going on here is that instead of having a large middle class in our society, the middle class is being squeezed and people are dropping into the lower classes, can't make it, or becoming very, very wealthy. And these are the people you read about in popular magazines buying $100 million houses. So are we in a recession? Depends on who you're looking at. And I'd say for the average guy, things are tough. You remember a few weeks ago, there was a guy named Mike Green, I believe it was, who put the numbers together and said that a family of husband, wife, and two kids had to earn $140,000 a year to not be severely stressed and moving downward. And I think he's right because you add up the cost of medical insurance. I don't call it health insurance. It doesn't insure your health. Child care for your two kids, one thing and another. Yeah, I think the standard of living of the average American is going down. So yeah, we're in a recession from that point of view. But I don't trust the Fed's figures. I don't trust them much more than I trust the figures of the Argentine equivalent, frankly.
So, Doug, you mentioned the stock market at all-time highs. I think it was Dr. Mark Faber I've had as a guest here on the program in the past as well, who recently pointed out, I think it was just last week, that the price to sales ratio on the S&P 500 has never been higher, that investors are now spending a lot of money just to get $1 in revenue, and it's higher than it was at the time of the tech stock bubble. What's your forecast for stocks? Do you see the market continuing to go up as the Fed drives inflation, or do you think we're in for a correction?
Well, the stock market has been driven in recent years by tech stocks. And of course, artificial intelligence stocks in particular have been the biggest part of that bubble. Answer to the question is no, I'm not involved in it because it's very, very expensive at this point. And I'm kind of a value guy. But more than that, feeling the way I do about the ultimate fate of the dollar and the fact that the economy is way over financialized and there's way too much debt in the world. I've always had a specialty in precious metals, gold, and in particular, mining stocks. And they've been a fantastic place to be for the last couple of years, at least. In fact, I'm sure I would have mentioned that the last time I was on with you and a lot of these smaller mining stocks have gone up 2, 3, 4, 5, 6 times in price since then. But I don't recommend that the average guy buy small mining stocks because most of them are burning matches and it's a specialist area. But at the same time, I don't see why the average guy is involved in high tech stocks because nobody really understands AI either. So it's gambling, not investing.
So, Doug, what do you make of the recent significant correction in precious metals, particularly silver? Does it change your outlook?
It's fascinating to think that gold is at $5,000 an ounce and silver is, well, it's going up and down like an elevator with a lunatic at the controls. I don't know what it is as we're speaking right now. Let's say it's $80 or something like that. These are new all-time highs. And what's going on is that, certainly in the case of gold, central banks who mostly have federal U.S. securities, U.S. dollars as their assets, all these foreign central banks, especially since the West confiscated Russian assets, a lot of foreign central banks realize more and more that the dollar, not only is the dollar the unbacked liability of a bankrupt government, a fiat currency that can be created at will, but it can be confiscated at will in the case of the Russians. So what are people doing? What are these foreign central banks doing? They've been buying gold, getting rid of dollars and buying gold. So now that gold is at $5,000 an ounce, it's no longer underpriced relative to things. For many years, gold was cheap relative to a suit of clothes, a meal in a restaurant, this type of thing. Well, that's no longer the case. I think what we're looking at now in the case of gold and silver, which are two different things, actually, they're different dynamics. Silver is going up partially for the same reason, but partially for very different reasons than gold. I think what's happening with gold is that since it's the only financial asset that's not simultaneously somebody else's liability, that's why central banks have been buying gold. The public is not buying gold. I mean, that's not the case. This is not a retail mania. This is a central bank driven thing. Anyway, look, what do I think is the cheapest place to be if you want to be in the stock market? I think it's oil stocks. You can get 8 to 10% yields on quality oil stocks. Another thing that I promise you nobody's looking at is coal stocks. You can get 10% or more in dividends on coal. And one thing that we need in the world, and we'll need much, much more of, is energy. And that means hydrocarbons and nuclear. I'm also a big fan of uranium for that reason. So that's where I am. I'm not joining the tech bubble.
Doug, when you look at currencies, and by the way, if you're just tuning in, I'm chatting today with Mr. Doug Casey. He is a multiple-time best-selling author, respected commentator. Always a pleasure to catch up with him. Doug, the world of currencies is becoming extremely confusing. You mentioned that central banks are ditching their dollars or they're moving those assets into gold. You look at the BRICS countries that now rolled out a gold-backed currency, 40% backed by gold. Bitcoin is crashing. It's just confusing when you look at currencies. The US dollar now, you're looking at the dollar index, which compares the purchasing power of the dollar to the currencies of the trading partners of the US, down lower than any point, I think, in 15 years. What's your forecast for fiat currencies moving ahead? Do you have a favorite? What do you see about crypto? That this whole area is kind of confusing.
Well, foreign currencies, I guess it's fairly pointless to talk about them. Many years ago, I used to recommend that any American have a Swiss bank account for purposes of privacy, and also because the Swiss franc has historically been the best managed of all the world's currencies, and it still is. When I lived in Switzerland many years ago, the Swiss franc was 23 cents. Today, the Swiss franc is what? I don't know what it is right now, $1.25. But that's academic for most Americans because it's extremely hard, almost impossible, for the average American to set up a foreign bank account. They won't take your business. It's not because there's a law against it. It's because foreign banks find Americans more trouble than they're worth because of U.S. rules. That said, if you can, you still want to have a foreign bank account in a sound foreign currency, and the Swiss franc would be your first choice. But like I said, for the average person to open up a foreign bank account, forget about a Swiss bank account. It's very, very hard, almost impossible.
What about Bitcoin's crash? Are you a crypto fan? What do you see happening in that arena?
I was a late adopter to Bitcoin. I only got into it in 2017, and it's been good to me. But it's extremely volatile, always has been. It's the new kid on the block. But I guess the answer to the question would be, is Bitcoin a suitable money? Can it be used as money? And my answer to that question is yes, it can be, because there are 5 characteristics of a good money that Aristotle laid down in the 4th century BC. A good money has to be durable. That's why we don't use wheat as money. It has to be divisible. That's why we don't use artwork as money. It has to be convenient. That's why we don't use lead as money. It has to be consistent. That's why we don't use real estate as money. No two pieces are exactly the same. And it has to have use value, which is why we shouldn't use printed paper as money. It has no use. And there's a 6th reason, too. It can't be created out of thin air. Now, gold suits those 6 characteristics of a good money better than any other thing, actually anything. Any of the 92 naturally occurring elements, gold is better. But Bitcoin also suits those 6 characteristics, and it's quickly transferable, much more so than gold. So that, yeah, I think that Bitcoin will gradually be adopted as a alternative money. And it's gone from pennies to, I don't know what it is, $65,000 today, down from, I think it hit 140,000. Yeah, I would be buying Bitcoin in this area. Yes, I would, frankly. And if you're a speculator, you can buy Michael Saylor's strategy company, which is basically a publicly traded stock that is a play on Bitcoin.
Doug, 18 minutes has elapsed. I can't believe how quickly a conversation goes with you. So much more we could talk about, but the clock says we have to leave it there. My guest today has been Mr. Doug Casey. Doug, always a pleasure again to catch up with you. I mean that sincerely. One of my favorite interviews. Thank you for joining us today.
Appreciate that, Dennis. Thank you.
We will return after these words. Dennis Tubbergen here, host of RLA Radio. I'd like to invite you to get my latest special report titled 3 Retirement Mistakes. If you're already retired or you aspire to a comfortable, stress-free retirement, this report will not only outline the 3 most commonly made retirement planning mistakes, but also help you put guardrails in place to avoid them. These 3 retirement mistakes occur because of the macroeconomic cycle that continues to repeat itself. In the report, you'll discover where we are in this macroeconomic cycle and what 3 mistakes you could potentially make as a result. To get your copy of this free report, all you need to do is visit requestyourreport.com. The website again is requestyourreport.com. Just let me know where to mail your complimentary copy of the 3 Retirement Mistakes Report, and I'll be glad to do so. Again, the website, requestyourreport.com. Welcome back to RLA Radio. Whether you're watching or listening today, thanks for tuning in. And thanks again to my special guest, Mr. Doug Casey, for joining us on today's program as well. You know, if you've been at all paying attention to U.S. government Treasury auctions, there are three types of debt that are sold in an auction. There is a bill, there is a note, and there is a bond. A bill is typically defined as U.S. Treasury debt with a maturity of 2 years or less. A note is somewhere longer than 2 years, but not longer than 10. And a bond is typically longer than 10 years. So bill is the shortest term maturity, followed by a note, followed by a bond. Wolf Richter published an article last week. In the article, he noted that week there was $701 billion of Treasury debt sold. Of this debt that was sold, 160 billion was a note or a bond. 160 billion. That was 74 billion financed over 3 years, 54 billion financed over 10 years, and 32 billion financed over 30 years. The remaining $541 billion that the U.S. government financed were Treasury bills. These bills had maturities from 4 weeks to 26 weeks. That means in 4 weeks to 26 weeks, which is 6 months, the U.S. government has to refinance this debt again at whatever the prevailing interest rate might be. Now, when you dig into these maturities of 4 to 26 weeks, it's even more alarming when you see how short term some of this debt has been financed. 105 billion of the 541 billion that was financed short term needs to be refinanced again in 4 weeks. In 6 weeks, 95 billion needs to be refinanced. In 8 weeks, 95 billion also needs to be refinanced. So that means in the next 8 weeks, there's about 300 billion of that debt that needs to be refinanced once again. This is a debt snowball that's rolling downhill, and as time passes, the snowball is rolling faster and it is getting larger. This is a trajectory that cannot continue. I talk about this trajectory in my report for this month. It's titled 3 Retirement Mistakes and How They Might Affect You. I'd love to send you a copy absolutely free. All you need to do to get your free copy of this report is visit requestyourreport.com. Let me know where to mail the report. I'll be very glad to do so. Again, that's the 3 Retirement Mistakes report. I'll send it to you when you visit requestyourreport.com and let me know where to mail it. That's my program for this week. Hope you got something you can use, and I'll be back again next week.